Most financial turning points don't announce themselves with chaos on the evening news. They arrive quietly, through strained supply chains, unusual behavior, and small signals that only make sense in hindsight. By the time the headlines catch up, the real move is already behind us. What's unfolding right now in the silver market fits that pattern perfectly. And if you're only watching prices, you may already be late. Markets rarely collapse with a single dramatic headline. They tend to crack in silence. Through shipping delays, inventory gaps, and subtle warnings most people dismiss as noise. When the story finally becomes mainstream, the damage, or the opportunity, has usually already taken shape. That is precisely what's happening in the global silver market today. Across the largest bullion dealers in the world, something unusual and deeply unsettling has emerged. Consensus. SD Bullion, JM Bullion, and APMEX, pillars of the physical metals industry, are all reporting the same disruption. The 1,000-ounce COMEX good delivery bars, the backbone of institutional silver trading, are simply gone. These are not consumer products. They aren't coins, novelty bars, or collectibles. These are the settlement bars used by banks, hedge funds, and major institutions to clear contracts worth millions. When inventory at this level disappears, it doesn't suggest casual buying. It signals urgency among serious players. At the same time, fulfillment timelines are quietly breaking down. Shipping delays are now stretching toward 5 weeks. Dealers are issuing notices about restricted availability, extended delivery windows, and pre-order limitations. This isn't salesmanship. It's operational stress from firms struggling to source enough physical metal to meet demand. Then came the data that even longtime skeptics could no longer brush aside. Google search trends reveal that interest in buying silver has surged to the highest level ever recorded, higher than the 2011 rally, when silver briefly flirted with $50 an ounce, higher than the panic of 2020. This isn't a gradual climb, it's a vertical spike. Millions of people across continents searching for the same thing at the same time, physical silver. But this is where the story takes a far more consequential turn. Historically, retail buyers never set silver's price. That power lived in paper markets, COMEX futures in New York and the London bullion system, where contracts dictate value without requiring metal to change hands. Physical buyers simply paid a premium on top of the paper price. If silver traded at $30, retail buyers might pay $35. In times of stress, premiums widened, but the core price remained anchored to paper trading, until now. For the first time in decades, the physical market is pushing back. Real metal is becoming difficult to source at current prices, and traditional paper mechanisms are showing strain. Industry insiders aren't calling it a squeeze yet. They're calling it a scramble, a warning that supply is no longer flowing smoothly. And when physical demand overwhelms paper supply, markets don't adjust politely. They reprice, often suddenly and often violently. This scramble isn't happening in isolation. It's unfolding alongside a deeper structural shift that is barely registered in mainstream financial coverage. In late 2025, a chart surfaced that should have dominated headlines. It tracked foreign central bank holdings of gold versus U.S. Treasury bonds over the last half-century. For 45 years, central banks favored Treasuries, yielding interest, offering liquidity, and representing the ultimate safe asset. Gold simply waited in vaults. Then, without fanfare, the lines crossed. For the first time since the early 1980s, central banks now hold more gold than U.S. government debt. The most conservative financial institutions on the planet are quietly rotating away from paper promises and back toward tangible assets. And historically, when gold moves, silver follows. But silver carries an additional burden. Gold does not. It's consumed. Solar panels, smartphones, electric vehicles, medical equipment, and AI data centers all depend on silver. Once used, much of it is gone forever. Gold can sit untouched for centuries. Silver cannot. Despite that reality, silver was already trading near $75 an ounce in early January 2026. That's when two analysts entered the conversation with projections that would have sounded reckless just a year earlier. The first, known as Rashad, has earned a reputation for calling silver inflection points with unsettling precision. His work is cold, mathematical, and devoid of emotion. In early January, his conclusion was simple. Silver was setting up for a rapid move to $100 an ounce. Not someday, soon. His logic was direct. Silver had already tripled in 2025, rising from roughly $25 to $75 in under 9 months. If that momentum merely repeated, prices would overshoot $200. Why, he asked, would a proven trend suddenly fail? He wasn't alone. Veteran analyst Gary Savage reached the same destination using a different route. His technical work identified a classic bull flag, an explosive rise followed by tight, orderly consolidation. Bull flags aren't reversal patterns, they're pauses before continuation. Savage concluded the consolidation would resolve within weeks, projecting a move toward $100 within roughly 60 days. Two analysts, two approaches, one shared timeline. To newcomers, $100 silver may sound theoretical, but the implications are anything but. A buyer at $25 in early 2025 would be sitting on a fourfold gain. Even modest institutional exposure would outperform nearly every major asset class. More importantly, $100 silver would be a signal, not of speculation, but of stress, a visible crack in confidence toward paper currencies and the systems that support them. And this awakening isn't limited to the West. After the New Year holiday, Chinese buyers flooded the Shenzhen gold market ahead of the Lunar New Year. Footage showed crowds buying with urgency, not curiosity. The West is scrambling for silver. The East is accumulating gold. Central banks are stepping away from paper. When those forces converge, history suggests the outcome is rarely subtle. Critics, predictably, are calling it a bubble. Silver has risen too fast, they argue. The move looks parabolic. Under normal conditions, that skepticism would be justified. But it rests on a dangerous assumption that price alone tells the story. It doesn't, because this move isn't being driven by hype alone. It's being driven by shortages, structural shifts, and a quiet erosion of faith in the paper systems that once dictated the market. And that is why the next 60 days may permanently redefine silver's place in the global financial order. When accusations of a silver bubble started echoing across financial media, one analyst answered, not with outrage or hype, but with arithmetic. Jesse Colombo, well known for spotting genuine market bubbles years before they implode, released a methodical rebuttal that quietly unraveled the entire narrative. His argument was disarmingly simple. Price alone tells you nothing. An asset cannot be judged in isolation. Value only emerges through comparison, and once silver was measured against the right yardsticks, the bubble thesis collapsed almost immediately. Colombo began with the silver-to-Dow ratio, a long-standing metric that asks a basic but revealing question: how many ounces of silver does it take to buy the Dow Jones Industrial Average? In January 2026, with the Dow hovering near 45,000 and silver around $75 an ounce, the answer was roughly 600 ounces, a staggering 600 to 1 ratio. Historically, that figure wasn't just high, it was extreme. At the peak of the 1980 precious metals bull market, fewer than 30 ounces of silver were needed to equal the Dow. Even during the much-discussed 2011 silver surge, the ratio was dramatically lower than it was in 2026. By this measure, silver wasn't overheated at all. It was historically cheap relative to equities. But Colombo pushed further. He turned to a comparison that exposed the scale of monetary distortion. Silver versus the M2 money supply. M2 represents the total pool of cash, checking deposits, and near money circulating through the system. Since 1971, when the dollar's final tether to gold was cut, that pool has grown at a pace that defies intuition. Quantitative easing, pandemic stimulus, and chronic deficit spending injected trillions upon trillions into the system. Silver production, meanwhile, barely moved. When total M2 was divided by the estimated amount of above-ground silver, the implied valuation didn't point to $75 an ounce. It pointed toward levels approaching $1,000. Suddenly, the idea of a bubble looked almost comical. If anything, silver appeared profoundly undervalued. The most jarring comparison, however, came from the oldest ratio in monetary history: gold to silver. For thousands of years, long before central banks, futures exchanges, or fiat currencies, gold and silver traded in a relatively stable relationship. In many ancient civilizations, 10 ounces of silver equaled 1 ounce of gold. During the Renaissance, the range often sat between 10:1 and 15:1. In January 2026, with gold near $4,400 and silver around $75, that ratio hovered close to 61. That wasn't tradition, that was distortion. Even a modest reversion to 21, still well above historical norms, would place silver near $220 an ounce, assuming gold went nowhere. And gold wasn't standing still. It was climbing. What critics consistently failed to acknowledge was a fundamental shift. Silver is no longer just a monetary metal. In ancient economies, silver circulated as money and rested in vaults. Today, it's consumed. Hundreds of millions of ounces vanish each year into solar panels, electronics, medical devices, electric vehicles, and now, AI infrastructure. Much of that silver will never return to the market. Not because it doesn't exist, but because recovering it simply isn't economical. That reality makes modern silver different from any version that came before it. It is both a store of value and an industrial lifeline, a hybrid asset facing shrinking supply and expanding demand. When skeptics stared at silver's price chart and shouted bubble, they weren't studying fundamentals. They were reacting emotionally. They were trapped by recency bias, the human tendency to assume the recent past defines what's normal. If silver trades between $15 and $30 for a decade, the mind anchors there. A move to $75 feels excessive, even if the world that produced $15 silver no longer exists. And that world had changed. Money supply had exploded, industrial demand had surged, central banks were retreating from paper, geopolitical risk was intensifying, physical supply was tightening. In that context, $75 silver wasn't a speculative frenzy, it was a delayed recognition of reality. Then came the weekend that compressed timelines. In early January 2026, global tensions were already elevated, but events involving Venezuela accelerated processes analysts once believed would take years. Setting politics aside, the facts were stark. The United States made an unprecedented move that effectively asserted control over a sovereign nation's assets. Venezuela holds some of the world's largest oil reserves and maintains close relationships with China and Russia. Public debate focused on diplomacy and international law. Quietly, however, another audience was paying attention: central banks. They remembered Russia's frozen reserves years earlier, hundreds of billions rendered inaccessible overnight. The lesson was no longer theoretical. Paper assets were only safe until they weren't. China alone holds over $1 trillion in U.S. Treasuries. What happens if relations deteriorate? What if escalation continues? The risk had been demonstrated in real time. And so the move away from paper accelerated. Gold and silver share a critical advantage that no bond or digital ledger can replicate. They cannot be frozen with a keystroke. They cannot be printed into worthlessness. They exist physically, under direct control. That realization was spreading, not just among governments, but among private capital as well. At the same time, a quieter transformation was unfolding: precious metal tokenization. The technology to issue digital tokens backed by vaulted gold and silver had existed for years, tradable instantly, divisible into fractions, redeemable for real metal. Gold tokenization had already proven viable. Silver was next. Once silver tokenization scales globally, it unlocks an entirely new demand channel. Millions of buyers seeking exposure without storage or logistics. When that demand converges with industrial consumption, ETFs, central bank accumulation, and retail scarcity, pressure becomes relentless. Supply, meanwhile, remains constrained. Most silver is mined as a byproduct. Production cannot surge on demand. At that point, the math stops being debatable. Demand is expanding across every axis. Supply is rigid. Price must rise to restore balance. The only variable left is magnitude. This wasn't a passing mania, it was a structural shift. And when paradigms change, prices don't move gently. They shock, they overshoot, they reset expectations. Silver wasn't nearing a peak, it was nearing an inflection point. The real question was no longer if silver would reach $100, but what the world would look like once it did. For those willing to look past the noise, the answer was already embedded in the data.